There are 10 huge mistakes I see beginners in the stock market make over and over again. Today, I'm going to tell you guys what those 10 mistakes are and how you can avoid them. I cannot wait to share this with you guys today. Hey subscribers, thank you so much for joining me today. I am Jeremy. This is the Financial Education Channel, and today we're talking about the top 10 mistakes I see beginners in the stock market unfortunately make over and over and over again, guys. So this is strictly toward the beginners in the stock market. You know, more advanced investors that have been doing it a few years, they get caught up into some other kind of mistakes that are a little different than these, but I think it's just a good refresher for even experienced investors to hear about some of these today, guys. So I'm going to really enjoy sharing it with you, and let's just get right into this. So we're going top to bottom, starting here at number 10. So number 10, beginners in the stock market, many times they think they're at a huge disadvantage to professional investors, people that are experienced. Why they are at somewhat of a disadvantage, we got to acknowledge that. That's kind of irrelevant for you as an investor, because it's not a competition. You're not trying to necessarily keep up with the professional investor, the one that's been doing it for 20 years, the one that's running a hedge fund, a mutual fund. They're not competition. You need to focus on your own game. Also, here's another big thing. Here's an advantage you might have, right? You might be a beginner in the stock market. You might only have a couple months experience, right? You might be 22 years old. Well, think about it this way. You're 22 years old. You might have some insight into some industries that some of the old fogies, the ones that are in their 40s, 50s, 60s, that might have 20, 30, 40 years of experience, they might not understand some of these things. Facebook, you know, that was a stock that was so misunderstood when it was an IPO. Like, people did not understand that company, but the younger investors, a lot of younger investors did understand and said, this company has a big future ahead of it. You know, I look at a Snapchat right now, it's definitely a company that's misunderstood. I'm not saying go out and buy Snapchat or anything like that, but that might be a stock that is certainly, like, people don't understand it. Like, a lot of people, let's say over the age of 35, 40 years old, they've never even created a Snapchat account. Never mind, they don't have an idea of how Snapchat makes money, how they, you know, to place an ad on there, some of those kinds of things, guys. So if you're younger, you got ideas into some industries that some of the older folks just don't really quite understand. They can't just grasp it around their head, because you're actually the one that's the target market, so you understand that stock. You know, I've seen industries like energy drinks. You know, not a lot of people understood that. They didn't realize how big of a threat energy drinks were to some of the big guys like Coca-Cola, Pepsi, and whatnot, and those kind of companies. So there's definitely some big industries that you're going to have some understanding over some of the big investors, and you're not going to have a lot of skeletons in the closet because you're a new investor. So, you know, an older investor, a professional investor, they might have skeletons in the closet as far as investing in some certain stocks. So they might be like, oh, I don't want to invest in that because such and such stock screwed me in the past, and that one's somewhat similar to that, so I can't touch it. You don't have to deal with any of that because you're brand new to this game, guys. So that's definitely one of the big mistakes, you know, thinking that you're at a huge disadvantage, because it's just not simply true. You might be at a disadvantage, but even if you are, who cares? You're not in a competition with the other guy. Number nine, huge mistake I see beginners make in the stock market is not reading the 10Ks, which is an annual report, not reading the 10Qs, which is quarterly reports, the latest one, and not listening to conference calls. These are the backbone work you need to do before you ever invest in a stock, in my opinion. You got to read through a full 10K and make sure you fully understand that company, everything in that 10K. You know, I get a lot of people saying, well, what part should I read in the 10K, 10Q? You need to read everything in there. Read everything. And then over time, you know, you might be able to say, oh, I don't need to read this section because I kind of understand that already, or things like that. But when you're in your first year of investing, 2 years of investing, read everything in that 10K, everything in that 10Q, everything. You listen to the latest conference call that the company had. These are all on the investor relations page of any public company. So you can go to, type in Google, Coca-Cola investor relations. Their investor relations page is there. Go to SEC filings. You can find their 10K, their 10Q, their annual report. All that stuff's there. The latest conference call. This is for all public companies out there, guys. So you can do that. And then after that point, you have a good idea about the company. Then you can actually go and invest if you like it at that point, and you like the valuation, which is is the next part after that. But not reading the 10K, not reading the 10Q, not listening to the conference call, huge mistakes in my opinion, huge mistakes. The work's got to be done, and that's the work. And if you can't get up enough to do that, then this whole investing game might not be for you at the end of the day. Number eight biggest mistake I see stock market beginners make is investing all their savings right away. So they research for a little bit here, and then they're like, okay, now I'm ready to invest. Then they just put all their savings toward it, whether they got $1,000, whether they got $10,000, they just invest it all right away. Just boom, it's all out there right away. You want to kind of work things in a little bit. Work things in, especially if you have a good amount of money built up. Like let's say you got $5,000, $10,000, $50,000 built up. You want to kind of slowly start investing that, because realize that sometimes the first stocks you might actually invest in might not be the best stocks. Like I remember the first couple stocks I invested in, they were kind of garbage stocks in my opinion. Like I'm look back and I'm like, why the heck was I in that company? That was a horrible stock to be invested in. Like what was I thinking? Sometimes you might think when you're in the beginner stage that, oh, I'm in the great stock, I'm in the right stock, and it might just not be the right one, guys. So invest a little bit, and then you can move on after that and get all that money invested over, a course of 6 months to the first year. Then you can get invested, but don't just stick it all in there the first week or the first day. It's a big mistake in my opinion. Number seven, the huge mistake I see beginners in the stock market make is they don't fundamentally think in their brain that they can lose money. You gotta come to grips with the fact that you may or probably will lose money at some point. It might be on that first investment. It might be on the second one. It might be on your 22nd stock you bought, 5 years from now. At some point in time, if you're in this game long enough, you're going to take a loss. It's going to happen. There's no way around it. I mean, I know no one ever in history, and there's been no one ever in history that's done this game for 20, 30, 40, 50 years and hasn't come across at least one loss or a few losses. I mean, even the great Warren Buffett and some of those guys, they've had some bad stocks they had to sell and they took a loss on because it just didn't work out. The fundamentals of the company changed. They made a mistake. Those things will happen. The trick is just to not get down about it. What I see with a lot of beginners in the stock market, they get hyped about the stock market and they're like, woo, 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 and they don't even really do the research or the work behind it. They just hear on TV, oh, somebody mentions a stock, or maybe they hear me on this channel that I talk about the stocks I'm buying, right? Maybe somebody just hears, oh, that stock, oh, that sounds good, I'm going to stick my money in there. Huge mistake. And then they don't realize that if that stock goes down, they could lose money. Their wealth will go down, right? Their account balance will go down. And they just end up selling, and then they take a loss, and they're like, screw the stock market, it's a big scam, I lost $100, I lost $1,000, however much it was, and then they just get out of it because they never came to grips at the start that, hey, I can take losses, I can actually lose money in this. You got to come to grips with that, and then you can move on into the stock market. Until that happens, just stay away from it because you're not mentally there yet. Number six. Worrying too much about geopolitics. This is another huge mistake I see so many people make all the time. You don't realize how many comments I get on this channel about, oh, do you think we're going to go into a recession this year? Do you think we're having a recession in 2018? Do you think, North Korea is going to, we're going to have a war with them and that's going to cause, World War III? Like all these geopolitic type questions. Why it's okay to pay attention to it once in a while. Why it's okay to kind of keep an eye over there about it. The fact that I see a lot of beginners in the stock market, and this is just a lot of people in general, they worry so much about these geopolitical type situations, these, oh my gosh, the world's going to end type things, that they end up never capitalizing on all the greatness. Because you got to understand, the majority of time, things are going to be good. There's going to be some times where things go bad, right? And that's just going to happen. But don't just sit there and worry about it all the time. Pay attention to it. If you see something realistically coming, then maybe you can get out of the market. If you really think like that's for sure going to happen, then maybe you can do that. But should worry about all the worries all the time. There's so much that could go wrong all the time, guys. Think about it. A major terrorist attack that could affect the markets horribly. Something where the stock market's hacked into or something, or electronic trading, like that could happen. Like, so many bad things can happen constantly. Every country, well, not every country, but tons of countries have nuclear bombs. Like, what happens if one accidentally shot a nuclear bomb at another country? There's so much There's so much that you could worry about all the time, and you'll never take part in the great system that you can take part in. You know what I mean? So you miss out on all those gains, those investment gains you make, because you're just worried about sitting on the sideline because this might happen, this might happen. There's always something that this might happen. I've been invested for 9 years now. There's always been people talking about there's going to be a recession. We're going to have a double dip recession. Look at how high the debt is. This stuff is talked about constantly. I've seen it time and time again. And I'm happy I didn't get caught up in all that, because I would have missed out on massive gains over the years, guys. So don't put too much, stock into what's going on out there in the world. Number five. Beginners in the stock markets don't realize how important emotional intelligence is. It's one thing to be mentally smart. That being mentally intelligent is very different than being emotionally intelligent. They're two different things. They're two very different things. Mentally intelligent is like, I can calculate this, I can understand an income statement, I can understand a balance sheet, those kinds of things. I can understand where an industry going. That's mental intelligence. Emotional intelligence is like, I'm down 30% on a position. Do I just sell out of that just because I feel bad about that stock? Just because I'm pissed? Or do I make this decision just because I'm emotionally feeling some kind of way? You're gonna feel emotions, and that's something I got to get across on this channel, because I've kind of misconstrued it like, don't feel emotions. You're gonna feel emotions. The question is, do you act on those emotions? Big difference between feeling an emotion and acting upon an emotion. I feel emotions all the time. Like, do I get fed up if a stock doesn't go up? Yeah, I do on the inside. Am I happy if a stock goes up? Yeah, on the inside. I try to stay as much even keel as possible, but the trick is I don't let, because I'm feeling a certain way, affect how I perceive the market, perceive a stock, those kinds of things, just because I feel a certain way emotionally in my heart. So that's a big thing. You gotta be emotionally intelligent. You gotta understand the emotional side of things. And if you can do that, then you can block out all the noise of the people saying, don't invest in that stock, when maybe you think that's the best stock to invest in. So you gotta be emotionally intelligent, guys. It's not just about being smart. Because if it was just about being smart, the people with the highest IQ in the world, they would all be the richest people, right? That's the truth. It'd be, the person that's got 130 IQ or 140 or whatever, I don't even know what the highest IQ is. Those people would be the ones with all the damn money in the world and all the power. And they're not. It's the ones that have an average IQ, but have an extreme amount of emotional intelligence that they can control situations. Number four. I see a lot of beginners in the stock market make the mistake of either not diversifying enough or diversifying too much. Now, when you first buy a stock, that's going to be probably the only stock you buy, right? Let's say you have $500. You probably just put the $500 in there. That's fine. But over time, over the course of the next year, let's say, you want to start owning a few stocks. You don't want to just still be in just that one stock you first bought. You want to start diversifying a bit. You want to own, let's say, once you're a year or two into it, you want to own about 5 stocks. Like 5 stocks, for me, is the perfect amount. As long as they're all in different sectors, doing different things, that's fine with me. That's like my ideal number 5. When you start owning, the max I want to ever own is 10 stocks. That's the max, like maxed out 10 stocks. And I don't think I've ever owned 10 stocks in my entire 9 years of investing career all at the same time. I've probably maxed out around 7 or 8. When I see people owning 15, 20 stocks, I'm like, why? Why do you want to own 15, 20 stocks? Stock number 17 is not even going to be close to as much belief in that stock as stock number 4 or stock number 6. Like, why do you want to own stock number 19 when you could just own more shares of stock number 6? Like, that's the way I think. Like, but you don't want to take it too far where you're just all in one stock or 2 stocks, because guess what? As soon as something goes wrong, which could happen with that 1 stock or 2 stock, either bad luck or maybe you just made a bad decision, right? Or a combo of both. When that stock gets hammered, you're going to get hammered. Your entire account's going to get hammered. So try to be in, let's say, 5 to 10 stocks. I would never say be more than 10. I would try to never be in less than 5 unless you're just starting, you're just starting out and you just invest in that first one. It's not like, if you have $500 to invest, don't split that among 5 different stocks. Like, invest in that first stock, then maybe buy $500 of another stock, then $500 of another stock till you got 4, 5, 6 stocks built up, then you're starting to get diversified as long as they're in different industries. Number three, see a lot of beginners in the stock market make the mistake of buying super high PE companies or unprofitable companies. So super high PE ratio, if you don't know that, research on my channel or Google it real quick, you can understand what a PE ratio is. A PE ratio basically is a valuation metric of a company. So I see a lot of people, especially beginners in the stock market, buy super high PE companies or ones that aren't even profitable yet. Those type of stocks, save those for when you're an advanced investor. Save those for when you're an advanced investor. When you're a beginner, don't touch those kind of stocks because realize you could take huge losses on those type of stocks because there's no limit to the downside. When a company is unprofitable or has a super high PE, like that valuation can come down drastically. It's much harder for a valuation to come down on, let's say, a Coca-Cola, a Procter & Gamble, because their earnings are steady. And it would get to such a point that it's like, this is ridiculous. Like if Coca-Cola dropped 50% tomorrow, like it wouldn't make any sense, like logical sense out there because they're way too profitable. But when you have basically very little profit or no profit at all, the downside is unlimited. And if you're a beginner in the stock market, you don't know if you have the emotional intelligence to even be able to handle a situation where stock goes down 30, 40, 50%, guys. So save those type of stocks when you're more advanced, when you understand more, when you know what you're doing, rather than when you're a beginner just jumping in these super high P companies or these ones that are unprofitable, because you might lose a massive quantity of money on those type of companies, guys. You might. Number two, selling a stock when it goes down instead of buying more. This is a huge mistake I see beginners in the stock market make. Now, if a stock fundamentals change, when you go to make an investment, right? When you go to make an investment decision, you should feel super confident in that investment decision. You should feel super confident in that company. If the fundamentals of that company change over time that are negative, that are not the way you thought they were going to be, then maybe you can sell out even if that stock goes down. But if the stock goes down and the company is still a beautiful company and you love it and you believe in its future, it only makes sense to buy more. Every time you buy a stock, there's a 50-50 chance of it going up, going down. It doesn't matter. There's a 50-50 chance. Now, if there's a bull market, maybe it's a little higher than a 50-50 chance. If there's a bear market, then there's a little higher, chance it's going to go down in the short term. But there's a 50-50 chance in that short term it's going to go up or go down. So your key is when it does go down, if you still love that company, if you still believe in it just as much, why would you not believe in it at $5 if you bought it at $10? Like, you know what I mean? That's just common sense. The only way is if fundamentals change and you're like, I don't like where the way this business is going, not where the stock price is going, I don't like where the business is going. If you don't like where the business is going, things have changed from the negative, then go ahead and get out of it if you want to at that point. But if you still love it, it only makes sense to buy some more shares because they're cheaper. If I love this shirt, and they had another one in this shirt, and it was $20 on the rack, right? And I go to H&M, and I'm like, I don't want to pay $20 for it, so I'm not going to, you know what? I think I will buy it. And there's another one, but they're out of stock, so I'm not going to buy that one. And the next day I go in there, and the other one I did want, the previous day's $10 now. I wouldn't all of a sudden say, you know what, since it's $10 now, I don't want to buy it. Like, that makes no sense. If it was $10, it's $10 savings I'm getting at the end of the day, guys. So make sure when your stock dips, if the fundamentals haven't changed, if you still love the company just as much, or maybe even more, buy some more in the dip. Every single company I've ever done that with, it has worked out in the end. And that's a lot of good investment decisions on my part. But there's not one stock, well, there is one stock as of now, we'll still see, the verdict's still out. GoPro is the only stock in my entire investing career that I've averaged down, and it hasn't worked out yet. We'll see if it works out over time, maybe in a year or two, it's a different story, but it's the only one right now, as of right now, in my 9 years of investing that has not worked out. And I've done that with almost every single stock because a lot of stocks I bought in the short term, they end up going down. 50% of them have. That's the bottom line, guys. So take advantage of that. Last one, number one mistake I see beginners in the stock market making is investing in stocks that are outside of your circle of competence. A circle of competence meaning what you truly understand. And to truly understand it, you need to read through the 10K, 10Q, listen to conference calls, all those kinds of things. I see a lot of times beginners in the stock market, they'll invest in a stock that they don't really even understand the sector that stock's in. They don't really understand the competitive threats to that company. They don't understand the business as a whole. They don't really understand how the company makes the gross margin it makes. They don't understand these kinds of things, and they'll stick money in a stock that they don't fundamentally understand. If you're going to invest in a stock, make sure you 100% believe in that stock and you 100% understand the stock. You can, like, if somebody asked you, hey, what stock should I put all my money in, or whatever, or what stock are you hyped on right now, you should be able to explain that stock in such a simple manner to them that, like, this is how this company is, this is how they make their money, everything. Like, if you can't pitch me a stock in 5 minutes, no, if you can't pitch me a stock in 3 minutes, then you don't have a true understanding of that stock. End of the story. End of story. I hope you guys enjoyed this. Top 10 mistakes I see beginners in the stock market make over and over again. If you just came across this channel, you may want to subscribe. We talk personal finance in the channel. We talk entrepreneurship. I'm an actual business owner. I give away so many business tips. We talk the stock market, the most of everything, including videos like this, how to be a successful investor, and from time to time, beginner in the stock market type videos. Thank you for watching, guys, and have a great day.